Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The nature of a bull call spread is, as the name implies, it's a bullish play. Terry expects the spread to rise in value if the shares of FCG rise. He thinks that probably he would expect the spread to lose value if the underlying shares of FCG fall in value. He can only lose what he paid, but as far as profit potential, it's different than the long call. It's not unlimited. It's limited profit potential. So here, let's look at a P&L diagram of this. This is kind of like the long call, but it's truncated to the upside. So look, below the strike price of 21, if Terry holds this position all the way until expiration, both of those options will expire. That means they just simply kind of disappear off the face of his position. And the 35 cents that he paid for those options is gone. He no longer has the rights or obligations inherent in that spread. So if the stock is, or excuse me, I keep saying the stock. And again, that's, because it trades just like a stock. If the ETF is below 21 at expiration, Terry loses only his 35 cents. Now, if this ETF is above 21 at expiration, just like with the long call, Terry can exercise his 21 straight call and buy 100 shares per call of the ETF at 21. Here the break even, because he only shelled out 35 cents, here the break even is lower. It's 21.35. So the ETF doesn't have to move as much for Terry to have a profit as it does with just buying the 21 calls. Okay, so far, less risk, closer break even. This is great. But now look what happens if FCG is up at or above 22. Well, Terry sold those 22 calls. If FCG is above 22 at expiration, those calls can be assigned, and therefore Terry has to sell 100 shares of the ETF. But he bought 100 shares at 21 because he exercises his 21 calls, and then when he gets assigned, he sells those 100 shares per contract that he bought at 22. So basically, he locks in $1, right? Buys at 21, sells at 22. So his maximum profit potential is that dollar scalp that he can make minus the 35 cents that he paid out to buy the spread. So his maximum profit potential is 65 cents. You can lose 35 cents, make 65 cents. Now, I want to, I'm going to talk about this slide. I'm going to go back. Again, this P&L diagram shows the at expiration risk, but he doesn't have to hold it until expiration. He can take a profit or a loss prior to expiration, and that's beneficial for the old, let your profits run and cut your losses quickly. If it goes against him, he can turn around and close out that trade right away. And there are direction and time components to bull call spreads. So let's go back here for a second. What you're seeing here with this P&L diagram is the directional component of this spread, right? Basically, it says at expiration, if the stock's below 21, I lose 35 cents. Above 22, I make 65 cents. In between there, may or may not lose. The closer to 22 it is, the better. But now let's kind of think about this in comparison to that long call that we were talking about before. What if the stock rallies up exactly to 22 bucks a share? Which is better? the bull call spread or the long call? On which does, a trader make more? Well, if the stock is trading right at $22 a share, a trader would do better to have bought the bull call spread than the long call. Why? Well, because think about what the long call would be worth at expiration with the stock at 22. If somebody pays 50 cents for the 21 calls and the stock's at 22, you're going to make 50 cents, right? Your break-even's $21.50, and you make 50 cents above that. You make 50 cents with the bull call, just the outright long call. With the bull call spread, though, you make 65 cents because you only paid 35 cents for it, and up at 22, the spread is worth 65 cents. So now, hold on a second. In this particular scenario, where the stock rallies right up to $22 a share, I risk less and I make more. That's great. Now the trade-off is here, though. What if the stock is up at 23 or 24 or 25? Well, then clearly the long call would be better than the bull call spread. Because I have truncated profit potential with the call spread. But I have unlimited profit potential with the long call. If the stock's trading up at like 25, I'd make $4.50 with the call, but I'd still only make 65 cents with the long call. And TJ asks, can you successfully day trade the options on these ETFs? This is kind of a subjective question. If you ask somebody else, you might get a different answer. But it's not particularly easy day trading options. Have I done it before? Sure. I haven't talked to many people who have told me that they have a permanent long-term strategy of day trading options and have been successful. But I actually have talked to a couple people who told me that they have had that success. Typically, most option positions require the options being held for some amount of time. And here's a perfect example. If the stock in this example, or I'm saying stock again, if the ETF FCG here in this example rises up to 22 like today, I'm not going to make 65 cents. I'm going to make something less than that. And then I'm going to have to wait for time to pass for me to collect my additional, profits leading up to 65 cents. This is just at expiration. So there is a time component really to all option positions, but especially with bull call spreads such as this. Jeff asks, would you close out the short side at 22 and let the long call run? Yeah, that may or may not be an adjustment. It depends on what happens, Jeff. Like, let's say, for example, I was a little bit bullish on this ETF. And, I didn't think it could get much above 22. But all of a sudden, some big news comes out on the natural gas industry. And, FCG shoots up to and maybe even slightly above 22, and it sure looks like it's going higher. That's one example where I might just close out that short call at 22 and just hold on to just the long 21 strike. And why? That goes back to what I was just talking about as far as, the long call has unlimited profit potential, but the bull call spread has limited profit potential. So yeah, there are certainly times where when the market conditions change, then I might change with it, and I always want to make sure that my position reflects my stance. If my forecast changes, my position necessarily must change as well. So, there is this time component and a directional component to the bull call spread. There may actually be a volatility component as well, which is a little bit more of an advanced topic, but let me just kind of touch on that for a second. If I buy a call, I have the risk of implied volatility changing on me. If implied volatility falls and I own a call, I can lose on the implied volatility change. Even if the ETF doesn't move, I can still lose on volatility. However, with a bull call spread, because I'm buying one option and selling another option, my implied volatility risk is way lower. So if implied volatility falls, even if the ETF doesn't move, I don't really lose as much, maybe not anything at all, if implied volatility falls. Now, I'm going to reserve some time here for questions, but in the interim, while questions are coming in, I want to point out that I'm giving a special offer here. I don't usually do this, but I like to do this for the ISD webinars. What I do here at Market Taker Mentoring is I offer personalized one-on-one options education. I do things a little bit differently than other people do. What I do is when you first sign up, I give you an assessment, an initial assessment. And it's basically kind of a knowledge test, but also a psychology test. Who's your broker? What kind of things do you trade? What are your goals? And I do it all myself. I find out who you are as a trader, and I make you a better trader. I don't try to make you into another me. I don't purport to have the, holy grail strategy. I take how you're trading and I fix you. I make you better. I find the problems and I turn and I give you the solutions, and I make people better traders. So you have 9 personalized one-on-one sessions with me. I give you homework after each session. We usually do it during the day so that we can look at real market prices. I send you out my book, Trading Option Greeks. I give you access to all my online content, and there's a good amount of it. Have you attend my online education courses, and you have lifetime alumni status, so you'll always have access to some of this information.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.